Micron is trading at its 52-week low after reporting Q1 numbers today, and the question on every investor's mind right now is how much lower are these chip makers going to go, and is this the time to step in and buy? We'll answer both those questions on today's episode as I'll talk about Micron's Q1 results and the trajectory of this business. But with all that being said, how's it going? Welcome to Everything Investing. I hope you're having a great day. Again, we will be doing a full analysis on this business, starting with the fundamentals, the top line, bottom line, balance sheet, cash flows, all that. And finally, we'll conclude this video with a valuation of this business using our intrinsic value calculator to see where the buying opportunities are with Micron's business. And as you can see at the bottom of the screen here, we do have some key metrics that are lining up. We'll talk about that more in just a little bit. First, I wanted to make mention that if you do enjoy this video, make sure to subscribe because we do post on here regularly analyzing the businesses that you are most interested in, and make sure to also comment down below on the stocks that you want us to check out and analyze on this channel. And with that out of the way, let's jump into the video. All right, and let's discuss their Q1 numbers. You might be wondering why the stock is down a few percentages after hours, and well, it's because of this. Their revenues are actually down 40% quarter over quarter and 47% year over year. Now they're only able to produce about $4.1 billion in revenue for this quarter at least, and that is a huge hit, okay? Why did they take such a huge hit? Well, if we look at their performance by technology, they have two main memory chips. They have their DRAM and NAND chips. Well, DRAM is actually down 41% quarter over quarter. Their NAND chips are down 35% quarter over quarter. A huge hit to this business, especially since shipment and demand has declined across the board. Now, if we look at this from a financial summary perspective, we can see here $4.1 billion in revenue for the quarter. Gross margin is up at 23% here. So that accounts for about $1 billion worth of the revenues. But then once we get down to our operating income here, we deduct $1 billion for their operating expenses. We're only left with operating income here of $65 million. It's actually an operating loss here for Micron. What exactly does that mean for this business? Well, if we look at this lovely chart from our video sponsor, Main Street Financial Data, first link in the description, you can really illustrate how this business has been performing over the last few quarters. As you can see, we have had that upward trajectory, ever since the pandemic, but recently we have seen that decline in revenues across the board. And, it was only a few quarters ago, they were up at $8 billion in revenues. Now we're all the way down to just $4 billion. And let me tell you, it is looking worse for their outlook as well. But again, make sure to check out Main Street because they're definitely helping us investors understand the key financial data for these public companies. All right. And if we take a look at their expenses, while revenues have been decreasing, our expenses have been increasing across the board. Again, a telltale sign of a business that is going to struggle fundamentally. And so it's no surprise to see that the stock is trading around its 52-week low right now. In terms of the business overview, they're saying the declines here in revenues are a direct impact from their pricing environment, which has deteriorated significantly over the past few quarters. They're going to be making a conscious effort to cut their capex and wafer costs as well in an attempt to recoup some of those revenues and recognize some more profits. They also made mention that inventory is going to peak next quarter and that it should improve after that for the following quarters, but we'll have to see how that actually plays out. And in terms of the balance sheet here, as we just mentioned, they do have a ton of inventory on the balance sheet, so their assets are going to be pretty heavy, and they are relatively light on liabilities here, not a lot of debt for this business. And so there is quite a bit of equity lying around in this business, and it has been growing year over year. So that is great, at least from a balance sheet perspective. If we look at this from a cash flow perspective, adjusted free cash flow, at least for this quarter, only came in at, it's actually a cash outflow of $1.5 billion. Okay, that's a direct result from $943 million of cash from operating the business, but then $2.4 billion in capex, of course, leaving us with that negative free cash outflow. But again, they do have enough cash on the balance sheet to level out the debt that they currently have as well. So not too much of an issue for investors there. What I want you to take away from their upcoming outlook and actions is, again, that they're reducing their capex in the future. They're trying to recoup more of that free cash flow, more profits for the business. They're reducing costs across the board as well as they are navigating this challenging environment. That being said, even with the cuts to capex, they did still buy back some shares for this quarter, and they paid out a dividend regardless of the fact that they had negative free cash flows. Nothing too surprising there. They are going to use debt to fund those shareholder returns with the hopes that that is not a long-term solution. In terms of their guidance for next quarter, it's actually actually not looking too great. They're saying it's going to probably come in a little shy of what it came in for today, in and around that $3.8 billion range. And so we can expect yet another poor quarter for this business. Now, in terms of an evaluation, as you can see from this chart from Main Street, we can see how this business has performed over the years. There's good times and then there's bad times, like you can see here, right? We're just coming out of a period where we had very exuberant, very optimistic fundamental performance, but we might be transitioning back into, a little bit of a more challenging environment for Micron. And with semiconductors alike, they are a cyclical business. So the best time to buy cyclical businesses is actually in the downturns, in the very worst fundamental situations, so that we can profit from the reversion in the cycle. And so if we estimate that this business can on average produce about $5 billion in operating income, at least in the down cycle, then when we plug that into our calculator, they do pay a dividend. If we require a 10% return and they're able to grow for the first 5 years at about 8%, that drops down to about 7% on a 10 PE. This stock should actually be worth in and around that $80 price range, about a $30 increase from where we are right now. Significant upside just in an average scenario and with poor fundamentals. Now, in the very best case scenario where we really ramp up over the next few years, the cycle reverts strongly and this business can actually grow in and around that like 15% range, dropping down to about 8% again for the 5 to 10 years after that on a, let's just call it 15 PE. The stock in that case would be worth $134. Massive growth from this point. And we are in an economic down cycle as well globally. So this isn't something that can't be achieved for this business. But in the very worst case scenario where more hardship is to come, less demand, more competition, the economy is still not improving just yet. They're only able to grow at 3% for the first 5 years. That drops down to just stable growth at 1%. They're not really growing at all, and they're trading at a PE of like 6 where they're currently trading at. The stock should actually be worth still $46 per share, which is right in around where they're trading at now after the shares have sold off a little bit. Again, we have to understand this is in the very worst case scenario. If I actually assume that it's going to be even worse than this, they can only produce about $4 billion in operating income for the next few years. Yeah, it looks a little bit different, but still we do have a benefit here in the best and normal case scenario. And if we see the opposite, where this stock really explodes back up into operating income levels of, $8 billion per year, yeah, I mean, massive growth in this business. And that's really the risk and reward here for this business that us as value investors have to discern. Is this business going to hit these levels again? Or will we see more performance like we did back in 2018? And if we zoom out a little bit further, back in that 2010 region, right after the recession back in 2009. So again, this is a cyclical business. The best time to buy is always during these dips. And then we see a rally and then a dip. Buy here, you rally. So that's the analysis for today's video. Again, make sure to check out today's sponsor, Main Street Financial Data. If you've enjoyed this video to this point, make sure to smash the like button, comment, subscribe, and I'll catch you on the next one.